Hey guys, Koukun here. In today's video, we're going to talk about index funds, actively managed funds, mutual funds, as well as exchange traded funds, or ETFs for short. So if you're someone that is just learning about investing and putting your money into the stock market and getting it to work for you, all of these terms can seem a little bit daunting. So I'm going to try to break it down just so that you get a firm understanding of the basics. I'm really going to keep it as simple and clear as possible. So let's start with actively managed funds. So these are investments where typically people are sold this kind of investment at most banks or most sort of investment companies, where you put your money in with other investors and then the fund chooses a fund manager. So this is a person who they hope to be someone who can pick and choose the best investments, and they're going to pay this person a lot of money. And the hope is that this person is going to choose, the next best companies or the next best bonds or whatever the investment class is. The hope is that with active management, where you're specifically choosing some investments and choosing not to invest in other investments, the hope is that this fund will perform more than what the overall market does. Generally speaking, most actively managed funds come with higher MERs, or management expense ratios. This is the fee you pay as an investor for the privilege of investing with this fund. These can range as high as 2 to 3% of the overall investment every single year, which is one of the reasons it's very difficult for an actively managed fund to actually beat the overall market after accounting for the fees, because they can't just do the same as the overall market to give the investor the same return. They have to actually beat the market by 2 to 3% just to break even as the overall market. And the hope is that they're actually supposed to do even more than that, which is something that's very hard to do. I think the statistics is like 95% of these funds can't do it over any sustained period of time. The worst part is the 5%, or that small percentage of funds that have actually outperformed the market over, say, the last 20 years. Those funds typically have a good track record, but what happens is that so many investors see that performance, see that they're doing well, and decide to put their money in after the outperformance has happened. So now these funds tend to be very large, making it much harder for that active manager to continue to outperform and beat the market. Warren Buffett is one example of this, where he's said many times where it's very hard to beat the overall market, especially when you manage a large amount of investments. And Warren Buffett is one of the few cases of active managers who has consistently beat the market throughout his investment career. Except in the last 10 to 20 years, it's actually been hard for him to outperform even the overall market. And he said this himself. It is one of the hardest things to do, which is to choose investments that can outperform the overall market. If you haven't guessed, I am personally not a fan of actively managed funds, and instead, I like to invest my money in index funds. The goal of an index fund is to match the overall market. And how they do it is that they try to follow what are known as indexes, which are a benchmark of a specific type of investment. So an example would be a little bit easier to explain this. So the most common index is the S&P 500. So this is the collection of the 500 largest companies in America, and an index fund of the S&P 500 would be an investment fund that tries to match the performance of the top 500 companies in America by their size. So for example, if Apple on a given day is worth 5% of the top 500 companies, the index fund would also have 5% of Apple. If a smaller company in the S&P 500 has 1%, the index fund would also have 1%. So you can see, by following an index, there's no active management of saying, hey, I think Apple is going to be better than Microsoft, or I think one company is better than the other. Rather, they just choose, okay, these 500 companies are the ones we're going to invest in, and we're just going to buy all of them. Typically, there's very low fees associated with index fund investing because there's no highly paid fund manager that they're hoping to beat the market. Rather, it's a collection of employees just choosing to track the index, and they just use spreadsheets, I guess, or software to just make sure that they're staying consistent with the overall index. So when it comes to investing in index funds, usually you have a much higher chance of beating any actively managed funds simply because you will get the market performance and you pay very little in fees, versus most actively managed funds pay a much higher fee, and as a result it's much harder for them to give you the same return after accounting for the fees. The only real downside with index funds is, since they don't charge much in fees, they actually don't compensate financial advisors to promote it. You can imagine a bank has an incentive to sell their own mutual funds because they make money on the fees that they charge on those funds. When it comes to index funds, the fees are so little, there's very little incentive for anyone to actually promote it, even though it's actually one of the best type of investments for an individual investor. This is how I personally invest any money that I have outside of direct ownership of rental properties. Next, let's talk about a mutual fund. Mutual funds have been given a really bad beating over the last couple of years because of the high fees that they typically have. However, something important to note is that there are mutual funds that are also funds that track the index. There are mutual funds that are index funds, as well as mutual funds that are actively managed funds. The mutual funds that are actively managed typically are the ones that you would imagine that come with the 2 to 3% management fees every year. However, Vanguard in America has a mutual fund of their S&P 500 index. So that comes with, I think, a tiny 0.03% management fee, and it's a mutual fund structure. So a good way to think about mutual funds is it's a structure that allows people to put their money together to invest in a specific type of investment. So by itself, it doesn't necessarily mean it's going to have high fees or low fees. It's rather the type of investment that the mutual fund is invested into that determines if it has a high fee or a low fee. So generally speaking, if it's a mutual fund that is invested in actively managed type of investments, the fee on those mutual funds tend to be higher. Again, like I mentioned, the 2 to 3% range, but there are mutual funds with low management fees. I consider anything under 1% low, and the index funds that I'm investing in have a fee of 0.25%. So if you can find something similar to that in the mutual fund space, you're golden. But generally speaking, it's not as common here in Canada, but in the States, like I mentioned with Vanguard, there are definitely options for mutual funds that are also index funds. Now, finally, let's talk about exchange traded funds, or ETFs. ETFs have become one of the most popular terms when it comes to do-it-yourself investing. They are commonly associated with index funds, and especially here in Canada, most of the good index fund options are exchange-traded funds. But there are also exchange-traded funds that are actively managed funds with high management fees. So just because it's an exchange-traded fund doesn't necessarily mean it's an index fund. So similar to a mutual fund, an exchange-traded fund is also a container that you put money into, and many investors put money into, that is invested in a certain type of investment, which can be both the index funds or the actively managed funds. The difference with an exchange-traded fund than a mutual fund is that an exchange-traded fund trades on the stock market. So you can buy shares of that exchange-traded fund. You can see the price going up and down every single day. If you want to sell it, as long as the stock market's open, you can sell it. If you want to buy it, you can buy it. It's immediate. Most mutual funds are private investments in the sense that they're hosted by a company. You send your money to that company, it gets invested in the mutual fund, and most mutual funds aren't traded on the stock market. So you can't see the price going up every minute. You'll usually get an update every day, every couple of days, every week, every month. So they'll give regular updates, but with an exchange traded fund, it's similar to a stock that you literally see the price go up and down each day, and it's very easy to sell or to buy. This can be a good thing, but also a bad thing. Many exchange traded funds are traded daily, by investors hoping to make tiny increments, well, basically day trading, and it's not necessarily something I recommend, especially to most investors who are not trying to do that as their specialty. If you're trying to invest, I would always recommend buy and hold is the best way to do it, and it's a lot less risk and it's just simple, easy, and straightforward. But again, I really want to make this clear. Do not assume that every exchange traded fund is an index fund, and don't assume that exchange traded funds automatically come with low fees. You can have exchange traded funds with fees as high as mutual funds, and you can have mutual funds with low fees. Mostly, exchange traded funds do come with slightly lower fees than mutual funds, but you really have to look for the exchange traded funds that are specifically index funds that have very low fees. And the two largest companies in Canada that offer exchange traded funds of index funds with very low fees are iShares and Vanguard. So iShares is owned by BlackRock, which is one of the largest investment companies in the world. And Vanguard is a company that was founded on these principles of index fund investing, and they currently offer some great options when it comes to index fund investing through exchange traded funds. So just to recap, actively managed funds typically come with high fees and generally underperform the market. I generally recommend do not invest in actively managed funds. Index funds generally come with lower fees and they try to track the overall market. These funds tend to perform better than actively managed funds simply because you get the overall market return and you have very low fees. A mutual fund is a structure of an investment. Generally speaking, mutual funds are actively managed funds that have high fees. However, there can be mutual funds with low fees and are index funds. And finally, exchange traded funds are similar to a stock. It trades on the stock market. You can buy and sell at any time. You can see the price go up and down daily. And it is also a structure that holds other investments. So you can have an actively managed exchange traded fund as well as an index exchange traded funds. Be very aware of the fees you pay even on exchange traded funds. Not all of them are equal. So I hope you found this helpful. If you have any questions, feel free to comment below. And until next time, all the best.